The monetary policy instruments of the CBCS are aimed primarily at influencing the liquidity of the commercial banks, as reflected by the current account balances of the commercial banks at the CBCS. Through liquidity intervention, the growth in credit extension, domestic spending, imports, and ultimately gross official reserves can be influenced. The bank has three important monetary policy instruments: the reserve requirement, open market operations, and the pledging rate. The reserve requirement is an instrument that directly affects the money-creating ability of the commercial banks. According to the reserve requirement, all commercial banks must place a non-interest-bearing deposit on a blocked account at the central bank for a specified period of time. By doing so, the liquidity of the commercial banks is constrained because the commercial banks cannot use these funds to provide credit extension. The bank also uses open market operations to conduct monetary policy. Compared to the reserve requirement, the open market instruments have less direct impact on the balance sheets of the commercial banks and are more market-oriented. The open market operations include the auctioning of certificates of deposit and the purchase and sale of securities issued by the government or bonds issued by government-owned corporations. Currently, the bank only uses the issuing of certificates of deposit as an open market operation. The bank holds weekly auctions of certificates of deposit with a maturity of 2 weeks and bi-weekly options of certificates of deposits with a maturity of 12, 26, or 52 weeks. During the weekly auctions, the CBCS announces the interest rate it is willing to pay, and the commercial banks can subscribe at any amount that will be fully accepted. Meanwhile, the CBCS announces the total amount of liquidity it wants to absorb during the bi-weekly auctions, and the commercial banks indicate for what amount and maturities they are prepared to subscribe at the interest rate indicated by the CBCS. Finally, the pledging rate is the rate at which commercial banks can borrow at the CBCS in case of a liquidity shortage. Because of the peg of the guilder to the US dollar, the interest rate in the international money market affects the interest rate in the money market of Curaçao and Sint Maarten. An increase in the US Fed funds rate immediately affects the international money market rates. Therefore, CBCS generally adjusts its pledging rate in line with changes in the Fed funds rate.